Joining in to discuss just that is Charandeep Singh, founder and managing director, as well as Varun Daga, the co-founder and fund manager at Girik Capital. It's been a while. Good morning, gentlemen. Avan joining in. Varun, I'm going to come to you first. Just wanted to understand from you how you're looking at the overall setup for the equity markets at a time when we're looking at the on-ground situation of COVID rather adverse. The fact that, there's also FIIs that are continuously pulling out. Although we may have DII supporting the markets, how are you looking at the overall play between the economy and what's happening with the equity markets today?
Thank you, Avan, and thank you all the viewers. Thanks for inviting us. So first of all, let me start by saying that we really feel for the Indian citizens and what's happening around us. I hope things get better soon. I hope everybody keeps their personal agendas on the side and just focuses on the country as one, and hope we get vaccinated soon. Coming back to the markets, markets, as we always said, has a mind of its own and probably is looking into the future. From the earnings side, we've had some good earnings in many fronts. Many sectors did well. So on the market front, I think things are looking all right. Market's not willing to sell off that easily, comes back strongly. So the bull market looks underway, looks to be robust. And till now, we don't. Of course, we've seen some pockets of overvaluation in some places, but overall, markets look fine and hope. In fact, before the second wave, I think we were just doing so well across all sectors, and this was a little bit of a setback. But hopefully, if things get back to normal on the economy side, I think market is just waiting for that issue to get sorted. But otherwise, fundamentally, we don't see any big reason except from the domestic. Probably demand might get a little affected, but on the global side, export side, I think there's a lot of opportunity, and there are some really good set of numbers there.
So Charandeep, if I may just take that point that Varun brought up with respect to the domestic demand perhaps being a bit of a concern, and a sector that's very intrinsically linked to that is the consumption or the FMCG sector. Add to that the kind of raw material price inflation that rears its ugly head every now and then seems to be a cocktail for not looking very optimistic in the long haul. How are you looking at all of these factors impacting the FMCG space? Add to that high valuations.
First of all, good morning to you and all your viewers, and I hope everybody is doing well, as Varun said. Coming to business and to answer your question, definitely I think you have headwinds in the consumption-oriented sectors, and I don't think these are they should come as a surprise to anybody, because you obviously have very high valuations. No doubt, many of these companies are performers and they're great companies, but it is extremely possible that you have earnings headwinds over here because of commodity price inflation and a consumer slowdown in general. So yes, whereas expectations may be very high from these sectors, you may not necessarily get the desired outcome in terms of long-term IRR. That is a possibility.
Right. Charandeep, one often wonders as to how long is the metals rally going to go, because even as of this morning, you've got copper as well as other base metals actually hitting a fresh all-time high. Back home, in any case, we've seen what a dream run the entire metals rally has been. But do you feel that there is more upside, or would you say that the best is behind us?
So let's break up this discussion, because I don't think it's easy to predict or answer this question, without actually sort of, maybe walking through what the drivers for the stock prices going up or down may be. So if you look at a lot of these sectors, they've sort of gone into hiding for the better part of the last decade. The last time you really saw metals performing was maybe in the rally from 2001 to 2008, and then a little bit at the beginning of this decade that just finished. But I think it's very important for us to understand that the profit pools in a lot of these metal companies are cyclical. and they got decimated for the large part of the last decade, both because of demand headwinds, many times because of raw material headwinds, and also lastly, many of these companies maybe didn't necessarily make the best capital allocation decisions. So, you tend to have a cocktail of cyclicality, capital allocation, and then markets tend to obviously react in an excessive manner, both pessimistically and optimistically, when it comes especially to cyclical companies, as we have seen. But to paint all the companies in the sector with the same brush is not fair. And also to assume that a rally would top out over here is not something that we should assume. Because, people obviously are talking about, the rally just being because of metal pricing. But, this rally could also be because a lot of these metal companies have gone about and restructured for the last decade. They have gone and cleaned up their balance sheet, divested non-core assets. The sector has got consolidated in a large way. If you look at the steel sector, for example, if you look at the top 4 or 5 steel producers in India now, they produce bulk of the metal, right? So that's a very big positive. In fact, through the NCLT procedure, a lot of valuable assets got gobbled up at what looks like very reasonable prices. So one you have is sector consolidation. The second thing you have is better asset allocation incrementally. The thing I would say is that the best steel companies in India produce a decent return on capital and have a very secular demand scenario. So if you look at them over the last 25, 30 years, they have done volume growth north of GDP, right? And that is quite commendable to be able to do that over long periods of time at a ROE that is in the teens. If you break down the India business I'm talking about, I'm not talking about the international businesses, you actually should have better valuations than you have seen in the past decade, much, much better valuations, right? So I think that, of course, right now, maybe in the near term, they're benefiting from a great pricing scenario globally. Now, assuming that even goes away, wind the clock back 5 years forward. I mean, if you're selling 50% more of the metal than you are today, you have a great chance at creating more operating leverage, especially if you're capital disciplined. So I think that, I think when, we spoke on your channel last time, maybe in September or October, when Varun and I were on the channel, these were stocks that came up on our screener. And we were wondering why they came up on our screener. And clearly it's proven itself in the sense that you started to have earnings come through and you've seen some stock price reaction. But let's not assume it's over, because these are not just companies that are tiny companies or small cap companies that have a very small profit pool. The profit pool is really large, and we believe that the winners could have a very long way to go here. So let us not assume this is a one-time thing or just a reset. It could be a compounding story as well. We should be open to that.
But on the other space, and this is a pre-pandemic trade, if one can call it that, has been specialty chemicals. Would you say that the re-rating in specialty chemicals is going to continue and there are going to be more and more opportunities from here onwards as well? Or would you say that the best is in the price already?
So there are two things here, Aisha. I think there's one which is growth and the other is multiple re-rating. I think multiple re-rating to a large extent is probably done. But in terms of the opportunity, I mean, we all know the opportunity size is huge. India being a hub for manufacturing, and all these companies have now become a sizable, they've become sizable companies now. With enough capital, they're generating enough capital on their own. They don't really need to borrow money. So they've become, they've become pretty much machines where, they can take up contracts from anywhere in the globe and produce at the cheapest cost. They've backward integrated so that, the pressure from China raw material is also reduced substantially. And they've become much, much better companies what they were a few years ago. Having said that, of course, one is valuation. They've run up a lot. But all we have to focus here is growth and the size of opportunity and use them. There are times where market corrects and you get enough opportunities and dips where some of these good businesses could be bought.
Right. Varun, what about pharmaceuticals? Would you say the same, that the best is behind us, or do you think the re-rating of pharma is going to continue because, in the post-pandemic world, it's just so ever-changing and dynamic a sector, so to speak?
No, so I don't think pharma the best is behind. It's pharma is a very, very typical sector, because every company pretty much has their own fundamentals. There are different sectors of pharma. There are APIs, there are formulation, there are domestic guys, there are export guys. One really needs to pick the leadership in different areas and what's really doing well. Pharma is a very, very typical story. One needs to understand it well. But we are seeing a re-emergence of pharma. Some of the pharma companies are showing up on our sectors. The pharma which is linked to the global US markets. So I think the story is still under play, and probably they have better times ahead.
Yeah.
Okay. We've always spoken about some of those opportunities perhaps in the old economy, and that continues to be a segment that is seeing, is showing signs of really getting into full-on growth mode at this point. We're also, of course, seeing a push when it comes to spending on infra and so forth from the government. But talking about some of those old economy names, utilities perhaps, etc., is this the right time to perhaps get into some of those segments, or would you say that things are starting to look a little uncertain, and perhaps the nature of investing or the portfolio mix may change, at least for the moment or for the interim?
Charandeep, you want to take that?
Yeah, sure. So, if I understand your question right, you're asking really largely about the industrial companies, right? I mean, when you talk about old economy, I guess you're talking about everything ex-pharma, banking, technology, etc. So, if that's the question, I think, again, I will answer the question similarly to what Varun said. There are several sectors within industrial, right? You could, for example, you had the metal pack, right? The metal pack, you have construction companies, you have companies like Larsen & Toubro, which are EPC companies, you have your power utility companies. Now, if you break down the Indian market, I would say there's pharma, technology, banking, industrials, large part, technology, and there's the oil and gas guys led by Reliance. So these are the major profit pools in India. Industrial is a very major profit pool. The problem here is that there's been very little growth, right? Now, in terms of where you started seeing the growth like metals, you saw how quickly the re-rating happened. So it takes a very skilled manager to be able to actually understand where that profit pool A has long-term potential and where the growth is going to resume. Because whenever the growth comes, you start seeing multiple re-rating very, very quickly. So, for example, I can guarantee you, if a Larsen & Toubro suddenly showed growth out of nowhere in the next 2 or 3 years, you would see a massive re-rating in Larsen's multiple. This is very common. So, in order to be able to pick these opportunities, it's very important to be systematic and to build a process. I'd like Varun to come in here on this process because I think, he's probably better to explain as to how we manage that process of finding sectors that could actually make money. But to answer your question more directly, no, we are not at present in many old economy stocks. We have presence in the metal companies. We've had those for the last 6 odd months. But, as far as the old economy stocks, we are very process oriented and we focus on our screeners, and our screeners really tell us where to do the fundamental research. So we are very selective and we are very careful before we get into anything. We need to make sure that there's money on the table, max amount of money with minimum amount of risk and quickly.
So Avan, I'll just add here is that, we are not great predictors of what's going to happen. And what we know is we are very conscious of what is happening today. And what we try to do is with those stocks or sectors that come up on our screener, we try to find a reason and try to find a sustainable reason that whether this can continue for the long run and whether the risk reward is in the favor. So like a metal example, 4 months back or 6 months back when we were looking at it, the price was really in the favor, right? Maybe today it's not. Maybe 1 month later it is. It depends on how the earnings play out and everything. So the point is that we are really focused on what really throws up on our screener rather than saying that the old economy is doing well, and rather than us predicting what's going to happen, we will say that okay, if my screeners are showing a name like NMDC, we'll look at it. If our screeners are showing a name like Hindalco, we'll look at it. So we did end up building positions in the metal sector, and way more than what's there in the index, because it was really coming up on our screen, and we really trust that that process really works.
All right, amazing. That was a really great answer and helps us to understand the process much better. Varun, when we're looking at consumption, and I know you already said, that of course naturally it'll be hit, but going forward, the domestic story, when everyone's been touting the India demand story and the fact that it's going to be unwavering despite the second wave. We were talking to KK Mistry this morning, and I mean, just touching upon real estate for a moment, but he spoke about how people want even bigger homes naturally as a function of what's really happened over the last year. And we've already seen real estate thrive, although that's a case in itself. But I just really want to understand going forward what you're factoring in there, or, in terms of a trend, and whether or not you feel consumption will come back in a big way, especially discretionary.
Sure. So, what we were seeing just before the second wave hit, the building material segment, there was a lot of companies that were coming up on our screener in that segment. Not necessarily the FMCG companies. I think the growth is probably really not there when you compare that to the valuation. So, in fact, we were seeing many of those companies going out of our screeners and rating really low some of the FMCG companies. But yes, the building material segment, we thought that could be a very interesting play, because the real estate demand after many years came back. And many of these companies feel that it could be sustainable. The numbers were good. In fact, even now the numbers are decent. We need to see what happens in the coming few quarters. But yes, I think that could be an area of strength. And again, I don't think many people have looked at some of those sectors for a long time. There are some decent companies in the building material space, and they could be fairly large companies overall. It is a sustainable trend, and they could be fairly large companies over a long period. We don't have any of them in the really large cap space. Most of them are mid or small companies. So one needs to look out for them apart from the index. So we are quite bullish on that segment. But of course, we need to see how the second wave pans out. Maybe a quarter of blip, but the story remains intact.
Charandeep, want to just understand from you, in these times of COVID, where companies have pivoted their models, their strategies, their overall way of operating, digitize or die seems to really be the mantra. Are there any particular sectors or any type of companies that you believe have managed to adopt this model quite successfully and that investors can look to deploy money in?
Without naming names specifically, I'll speak a little more generally about this. You find that, the top maybe 500 companies, listed companies in India, if you literally pull them out, I think pretty much all of them have had the capital, the kind of people and the technology to be able to use the last 1 year to, like you said, digitize or survive. So, unfortunately or fortunately, the big guys in India have all been forced to adapt, and they're gaining market share, the leaders, so to speak. The SMEs generally have suffered and have been probably slow to adopt. They have lack of capital. They have issues with, servicing their interest and paying their employees. So, you see this huge divide in India. But, I would say direct beneficiaries of of technology are many. If you look at all of India's IT services sector, it's such a massive profit pool. You leave aside the Infosys, Wipros, the HCLs, the TCSs, who combined probably make close to 1 lakh of flow and profit a year. You have a amazing second run of companies in the mid-cap space and a really good set of companies in the small cap and the micro cap space that are constantly doing stuff directly in the technology space, be it cloud, be it in software as a service, be it in software, be it in packaged software, IT product. We have small companies doing work in the area of telecom. There are tons, So I think that this is a sector that it's very evergreen in portfolios, and it has been a performer in India for the last 30 years. It has constantly gone up in not only in terms of share of the index, but the number of companies that are in the small cap and mid cap index in technology doesn't fail to surprise. India truly is a technology hub, and you have great engineers. And I think this is a very, very secular thing which doesn't seem to go away. And I think it's safe to say that over a decade, the profit pool over here only grows. Of course, there can be headwinds in terms of currency, human cost inflation. These things do, disrupt the earnings acceleration from time to time. But over a very long-term period, there is no dearth of companies over here. One were to go stock picking.
Varun, if I could take that question to you, perhaps pose it in a different way, with a lot of companies that are now going to be hitting the secondary markets, which are focused on technology in some way, be it fintech or be it directly within this space. Do you believe that there is a lot of opportunity emerging in companies that are now going to hit the exchanges or just have recently?
No, absolutely. I think this is it's a new India. We have a lot more people using data. Geo has completely, changed the country in terms of the penetration, in terms of speed. With our population, if you give capital to a great management and doing technology, I think sky is the limit. You have on the unlisted space, you have so many companies do so well. We've never seen so many unicorns come in less than 2 years, 3 years, 5 years of their operations, and I think this trend is very, very real. They have a lot of capital at their disposal, and with that kind of capital, I'm sure with that kind of capital and the kind of technology they have and the reach, and combined with the Indian population, I think there are so many areas where wealth could be created, and we are actually waiting that and hoping that some of these companies come to the listed space so that we can take advantage of it. Look at India Mart was one of the example. Again, reaching out to so many people and new businesses. These are businesses which the listed space has not seen. So I think newness always creates value, and
Okay, Charandeep, within the financials as well, given that it's still a little early or premature to anticipate the full impact of the second wave, until now commentary has seemed to be fairly comforting. Companies haven't flagged off any major risks that they're foreseeing. There have been, some requests for relief which the RBI addressed with measures for small businesses. But other than that, we have, as of now, not heard too much. Do you see a risk going forward, whether it be from another moratorium, which right now just seems to be more speculative, nothing in the works as such, or any other kind of collateral impact, given that given that many businesses will see the effect of a prolonged lockdown, perhaps by the next quarter or so?
Yes, I think, touching on financials, which makes up 40% of India's index, is wise. There is a problem. This has definitely come as a shocker to everybody, the second wave, and I think that the financials are directly impacted. If you especially look at SME portfolios and consumer loan portfolios, there is no question that delinquency will go up. Okay, so I think there is an earnings headwind here for the entire sector. Now that's obviously the negative part. Let's speak about what could be positive here from an investor's perspective. I think investors would be wisely to stick to the best financials in the country. So there are 4 or 5 of the very large financials which they don't need naming. I'm talking about the top 5 market cap banks or top 6 banks and NBFCs. Maybe there's one NBFC like Bajaj Finance, which extremely well managed, preemptive in taking COVID-related provisions. If you go out and look at the balance sheets of some of these large guys, they've used last year to clean up their balance sheets, and they have gone and taken provisions far ahead of time. So today, most are sitting on excess provisions. So these guys are the best to weather the storm. Delinquency will go up, credit losses will come additional, more than was expected this year. So yes, you have an earnings headwind this year, but you just have to focus on the guys who are best positioned to come out of this, and come out of this they will. So if you look at the top 5 or 6 guys in India, they're going to be lion's share of the growth, lion's share of the credit, and they will take up lion's share of all the capital that's going to be allocated into the sector. I think one has to be very picky when it comes to a second tier or a mid-tier bank or a small NBFC. One better have their thesis right and better be able to understand what the drivers of the earnings are going to be, and that they have an engine that will sail through the storm most calmly and certainly. So in short, focus on the big guys. They're going to do well.
Gentlemen, thank you so much for joining us today. Always great speaking with you here on ET Now.
Sure, thank you.
Thank you so much.
Hey guys.